We should never be complacent, and we never are. But of course, this is an element that needs to be factored in. And if you take a look, for instance, at the current euro area monetary policy, I would say I'm quite happy, if I may say so, with the interest rate levels where we currently are. But at the same time, I would not close the doors to further rate increases if necessary for two reasons. One is, of course, the labor market. We still haven't seen the wage growth peaking. But the other one, of course, is geopolitics. We may have more shocks that may drive inflation up. And that's why, of course, we have to remain very cautious about inflation developments. And geopolitics is, by all means, one of the key factors that may drive it.
So you mentioned that you're happy with the current level of interest rates, but given the complexity of the geopolitical scene, the way that you just described it, does that increase the likelihood that the ECB will increase rates at the next meeting?
No, I think the next meeting is a meeting to pause. By all means, there's still lots in the pipeline. We've seen inflation coming down. So I would say we're myself in a relatively comfortable situation, and I don't think that there is a need for rate hike in October meeting. But of course, we go from meeting to meeting, from forecast to forecast, taking a look at what happens in the economy. And as I said, even if the interest rate, which is our main tool, and that tool has been used most aggressively over the last year, I would say the next phase now is high for longer. Okay, to see that we can solidify this return to 2% in the second half of 25. But it's also aligning other instruments. For instance, the asset purchases or sales, whatever may come next.
Right. So when should the discussion on cutting PEPR investments start?
The discussion is about to happen, and the decision should be made in a gradual manner because, of course, we don't want to shock the markets by unexpected decisions.
Can I just come back to what you said about higher for longer? What does that mean, in effect? What are you waiting for? Are you waiting for the headline to get to 2%? Is that what you're waiting for?
Of course, we are still to discuss this in details, but my personal view is that, of course, waiting for the headline to come to 2% and only then seeing whether we should cut, given the lags in the monetary policy, then, of course, it would mean that we would be pushing inflation consistently below 2%. So I would say that's way too late. We should look at the forecast, let's say, a year and a half in advance, and if we see that the forecast consistently comes below 2%, then it's time, in my view, to ease up in terms of interest rates. But at the same time, what does it mean? And I would say not higher, but I would say high for longer, because we don't know where the rates will go.
Yeah.
Okay? We would hold on to this restrictive territory to make sure that really inflation is dealt with in one attempt.
You know, there's always this dance between inflation and growth. And, you know, here at the World Economic Outlook, we have seen the IMF downgrade their forecast for growth for the Eurozone. It's not recession, but it's not great either. Where would you say the pressures are greater now? Is it inflationary pressures to the upside or downside risk to growth?
I think it's much clearer to see that there are downside risks to growth, in my view. But at the same time, we're still, as for the euro area, it's more like lack of growth. It's more like maybe a technical recession, but we are not currently still talking about outright recession that would push up unemployment and would deal with inflation. It's not that kind of scenario. It's still kind of softish landing story.
Is it the base case, though, that for the next time that the ECB releases its forecast, which is in December, that essentially you're going to come out with lower numbers for growth?
We'll see. We'll see. Of course, there are lots of moving parts, but at the same time, I would not underestimate resilience of the European economy. There was already kind of flirting with recession at the turn of the last year, okay, and it kind of did not happen. Yes, we see some economies weaker than one would have expected, but others are doing relatively fine. So I would say it's still very kind of softish landing story at around being flat. That's perhaps the most likely story. And for interest rates, as I said, you know, for the time being, I think we can very clearly take a pause.